My name is Simon Angove, and I am the Senior Vice President responsible for Verint's Retail Financial Services business unit. Today, I'd like to talk about the case for branch workforce management. As you consider the case, think about these four things. First, the branch continues to be a critical channel for managing and growing customer relationships. Many people talk about the branch being dead. The branch isn't dead, it's just different. Yes, transaction volumes are declining as people migrate to alternative channels, but the branch still plays a critical role, especially when it comes to advisory and sales activities. According to research from Forrester, over 80% of customers still visit the branch to open a new account, and over 50% still visit the branch when trying to resolve a problem. So the branch is not dead, just different, and will continue to play a critical role in managing and growing the customer relationship. Secondly, restoring customer trust and confidence in the wake of the financial crisis is a top priority at the board level. According to research from Strategy 1, where they interviewed 30,000 customers across 25 countries, for the second year running, trust in financial services institutions is last among all industries, scoring 45%. It's even lower in the US and the UK. So there's a big job to be done to restore customer trust in financial institutions. And it starts, for example, with delivering the right level of customer service in one of your primary channels, the branch network. Third, increasing the sales performance of the branch network. We all know today that there is increasing pressure on margins, there's dwindling sources of fee income, and there's a smaller group of customers that you can sell to. It's more important than ever that we maximize every sales opportunity that walks into the branch channel. If we look at the performance across the industry and even across banks, in sales per advisor per week, a key measure of sales performance, we see this tremendous variation. We see the top performers generating something like 16 products per advisor per week, and the bottom performers generating something closer to 4 products per advisor per week. So there's a tremendous opportunity to improve the sales effectiveness in the branch. And it starts with capacity management by making sure that you've got the right number of sellers with the right skills aligned to market opportunity, and that you protect the time they have to sell. Fourth, last but not least, the dire need to reduce or control operating expenses. Typically, we see that about 50% of a bank's operating budget is spent in the branch network. A lot of that is payroll expense. Often we'll see that between 20 to 30% of the total payroll budget is telecashier payroll alone. So there's a huge job to do to make sure that that expense is being used wisely, and that where we can control or reduce that expense. In essence, it's about having the right number of people with the right skills in the right place at the right time, delivering the right outcomes. That means improved service by having the right number of tellers and cashiers to serve customers when they need them. It's about increased sales by making sure that you're aligning your seller capacity and skills with the market opportunity. And it's about reducing overstaffing by having the right number of people across the network and reducing idle capacity. Typically, through workforce optimization projects, we'll see clients reduce costs by between 10 to 20%. We'll see an increase in sales between 10 to 50% or more, and we'll see a reduction in peak wait times of between 25 to 50%. Celent, the industry-leading analyst, said in a recent report that in the first year of a project, clients can expect to see a $20,000 to $30,000 gain per branch without adversely affecting customer satisfaction.